Hey everyone, hopefully you're having a good day. My name's Andy. My channel's Finding Value. I was scrolling through the comments section. I was reading some of the comments, and I've got some guys that they're in the deflation camp. They're maybe perhaps worried that the dollar strength, that currencies outside the United States, they're pretty weak. They're having problems. People are running to the dollar. The index is going up, even though the dollar is going down. The dollar is getting smoked to the downside. It's just hidden because everything else is getting smoked worse. So we have worldwide inflation is what's going on. So in a worldwide inflation scenario, and these are bad inflations, we're not talking anything near deflation. And I know I've got some deflation guys in the comment section every once in a while saying that I should be listening to Lacey Hunt because of the debt overhang. I've listened to Lacey Hunt. I just don't agree with it. That's all. We have massive inflation worldwide. Will that continue? I think so, because if you have too much debt, what they do is they print it away. They in order for the system to survive, they have to have inflation for the debt. So what I've got behind me is I've got some indicators and some things to show you guys how things are correlated and how they move together. What I think is coming is when we have an expansion phase of real estate. I'm going to go back to that. In dollars, you're going to have inflation, and they're printing on top of it. They're doing all these games to inflate the debt, the debts away. And we have real negative rates. We have CPIs going up. We have PPIs going up, producer price index and consumer price index. These are prices, index of prices. These are just symptoms of inflation, but they're giving us other indications that the money is in the system. Velocity of money can drop, and you can still get massive inflation because what they're doing is they're creating the money and putting it into the banking system or somewhere at faster rates than what they can loan it out. So your velocity goes down even though the money supply continues to go up, which means that they're just creating money at a faster pace than what it's getting into the system. Velocity doesn't mean that it's a absolute value. That's not how it works. And when you're creating copious amounts of money in very short time frames, your velocity naturally goes down because of the equation. So if you've doubled or tripled your money supply in a very short period of time, which we've done, your velocity will naturally decline. But velocity has been going kind of sideways. And that right there is going to net you massive inflation. It doesn't have to go back up. It just needs to go sideways with them creating this amount of money. It just masks it in the calculation. So let's just say like you have a velocity of 1. It's 1 over 1. Or I'll say 50. So you've got 1 unit up top, 2 units on the bottom. And then you add 1,000 units to the top and the bottom. Your velocity goes way down. Because now you just basically made the numerator and the denominator completely different in the calculation by adding a whole bunch of stuff into it. It made the original values basically worthless. It just hides it. So what I've got behind me, I'll go over it. This is the 10-year Treasury constant maturity rate, and this is the consumer price index for all urban consumers, all items less food and energy. And what you see is you can kind of see that the consumer price index moves a hair before the 10-year Treasury maturity rate does. So the green line is just a line. The blue line is just shifted to the right of the green line for the most part. And it kind of lags it just a little bit. As you notice, you can see the peak here and then the lag of the peak. This peak could be this peak here. And this peak is kind of overlaid with this peak. And then you can see the decline and then the decline that follows and ensues all the way from 1980-ish all the way till late 2010s, early 2020s. So that's what we've got over here. Now, what leads the consumer price index? So the 10-year Treasury lags consumer price, and consumer price index, for all intensive purposes, could be inflation. Between that is your producer price index. Your producer price index, this is for all commodities. So basically, this is the input costs for consumers. has been moving on up, and this is a 108-year support line. We hit the support line here, and we've been rocketing higher. This PPI leads the CPI. The CPI will be rocketing higher, and we've seen it rocket higher recently. So the PPI is moving on up. The CPI is moving on up. And what makes me think that this is going to continue is the M2 money supply growth versus inflation. If you go on the right-hand side over here, we've got this very large printing of money here. This hasn't been accounted for in the inflation yet. Remember, M2 leads inflation by a few years. And if you look, you get this money supply printing, then the inflation comes. This money supply printing, then the inflation comes. And you can see they're offset by a little bit. This hasn't gone, this big, huge ramp up is what we are in. And inflation is coming. It's going to go way higher. And then someone says, well, look at it. It rolled over. Yeah, this is from like 25% rolling over to 13%. 13% of where this is higher than almost any time in history outside of the 1970s. So you're talking a massive wave of inflation coming, and the red line, inflation, this is M2 money supply. Inflation is going to come when this M2 money supply works its way through the system. And it first stops at the producer price index, which is rocketing higher here, which then will correlate to the consumer price index, which then correlates to higher interest rates eventually. That's just a free market and what the free market's done over time. I don't know how they're going to suppress it or do whatever they want to do. I'm just telling you that the M2 money supply is the first thing you look at to see where this inflation is going to go. And we have a long way to go higher. We could go 10, 13, 14 on their numbers, not the actual numbers. Now, I'm going to talk about a couple of things. Billionaire investor John Paulson is bracing for higher inflation and expects a gold rush. He's loaded up on mining and energy stocks in preparation. And that was written September 3rd, 2021. Granted, I loaded up on these things in 2020. Energy stocks and gold and precious metals and mining. Funny how we are of the same kind of same stance, the same paradigm. We're looking at this the same way. And who is Paulson? John Paulson is best known for betting on housing bubble to burst, a wager that generated more than $15 billion for his fund. His big short was immortalized in the book The Greatest Trade Ever, the behind-the-scenes story of how John Paulson defied Wall Street and made financial history. And here's some quotes he has. He says, gold does very well in times of inflation. The last time gold went sort of parabolic was in the 1970s when we had 2 years of double-digit inflation. Paulson added that gold can go parabolic because it is relatively small compared to the overall financial market. If you own long-term treasury bonds that are yielding 2% and interest rates move up to 5%, those bonds fall materially in value. He's talking about interest rates moving up and yields, the current bond yields being lower. And then what happens is bonds sell off quite dramatically. Likewise, if you have cash sitting in a bank that you're earning 0% on and inflation's at 4%, you're gradually eroding the value of your money. As inflation picks up, people try to get out of fixed income. Now he's talking about the rotation of money. They try and get out of cash, and the logical place is to go to gold. He added, because the amount of money trying to move out of cash and fixed income dwarfs the amount of investable gold. The supply and demand imbalance causes gold to rise, and the more it rises, it sort of feeds on itself and has the potential to go parabolic. Meanwhile, in a separate interview with Bloomberg, Mobius, which was another investor, said that investors should hold 10% of their portfolio in gold. He said that he also sees value in gold as the purchasing power of fiat currencies continues to erode. Currency devaluation globally is going to be quite significant next year, given the incredible amount of money supply that has been printed, he said. It is going to be very, very good to have physical gold that you can access immediately without the danger of the government confiscating all the gold. And what he's talking about is this M2 money supply and how this is ramped up. They're talking about next year and the inflation that's going to come from the ramping up of this M2 money supply, which will translate into inflation going vertical. And this is where I don't understand the deflationists. They're not looking at the M2 money supply. These guys printed it. It's in the system. It's going to cause higher inflation. These guys, seasoned investors, are seeing this. I agree with them. Let's go into some more things here. 3 years ago, John Paulson gave a keynote address at the CNBC Institutional Investor Conference. In his speech, he told those in attendance that he believes housing will continue its strong recovery for the next 4 to 7 years. And this was done in 2016, saying that the housing market has bottomed. It's not too late to get involved. I still think buying a home is the best investment any individual can make. Affordability is still at an all-time high. When asked how the average person could take advantage of the current real estate market at the time, Paulson said, buy a home, and if you can, buy a second home. 2 years ago, Paulson reiterated his statement saying, I still think from an individual perspective, the best deal investment you can make is to buy a primary residence that you're the owner-occupier of. So is what he said still true? It says the core reasons behind Paulson's statements still rings true today. But why does he believe homeownership is such a great investment? Paulson broke down the math of homeownership as an investment. Today's financing costs are extraordinarily low. He's talking about interest rates. The latest numbers from Freddie Mac show us that you can still get a 30-year mortgage at historically low rates of under 4%. And if you put down, let's say 10% on a house, it is up 5%. So you put 10% down, but your house is up 5%. He predicts then you would be up 50% on your investment. How many are seeing a 50% return on cash investment right now? Paulson goes on to compare the long-term financial benefits of owning versus renting. And you've locked in the cost over the next 30 years. And today, the cost of owning is somewhat less than the cost of renting. And if you rent, the rent goes up every year. But if you buy a 30-year mortgage, the cost is fixed. And I've talked about this in some of my other clips of people saying, what would I do right now? And my suggestion was to buy a house, lock it in with a 30-year fixed rate mortgage, have some friends live with you and pay the mortgage off with their money. Even better. Then you've got the upside of the house appreciating. And you're in the house making sure that people aren't destroying it. You own it. That's probably the least risk way to make the most amount of money as quickly as possible in an inflationary environment, and you lock in your interest rate at a very low rate. So I'm in the camp that we have inflation, not deflation. And the reasonings are right behind me. M2 money supply rocketing higher. Inflation's lagged behind it. Inflation's coming from that higher increased M2 money print. Historically, M2 money supply grows with the expansion phase of real estate. The expansion phase of real estate is inflationary and a leveraging up in that scenario. And whenever we leverage up, you get inflation. The deleveraging from real estate is your deflation. Some of these other areas like Japan and other areas that are high debt also had demographics where their real estate market went down over long periods of time. That's where that debt overhang comes into play and where the demographics also comes into play. I think that the demographics supports and the supply demand imbalance in housing, which is about 5.2 million, is the latest one that I've seen. We have a 5.2 million home deficit, which means that we have to build 5.2 million homes at some point, which will be inflationary because 80% of the mortgages, or I should say 80% of the homes, get a mortgage. So 80% of those new homes are going to get mortgages against them, which is new lending, which is expansionary of the credit and lending system. So we're going into an inflationary cycle. And the real estate cycle, I mean, we could go to a very large inflationary cycle where it starts today, or starts now, I should say, not today, but now, and goes over the real estate cycle where we could cycle down in real estate and it'll come back up. The thing is, the demographic does go away a little bit after the millennials. So it's going to be interesting to see what happens in the 2030s. That's where I'm going to be curious to see what happens. But between now and the 2030-ish mark, I see it as an inflationary environment. Now, what I've got here, just to show you a couple of charts, this is the CRB index, and we have this descending wedge that we've broken to the upside. The market agrees with this standpoint that we have inflation. It wouldn't be breaking to the upside. If we had deflation, you would have had your COVID sell-off, and this would have remained low and kept going lower if you had deflation. But it went higher, which means you have inflation. The market is telling you you have inflation. The deflationists are wrong, period. The market is telling you this. Oil, if we were having a deflation, would come all the way back down and wouldn't come back up. They're reflating it. They are putting money into the system. This is going to break to the upside, just like the CRB index did up here, and rocket higher. The setup is there. This is a liquidity-driven setup. Commodity super cycles are driven by liquidity, by dollar weakness. Now, when I say dollar weakness, I'm not talking about the index itself. I'm talking about we have inflation everywhere. We've got inflation all over the entire world. Do you think the entire world's going to run at assets like commodities and precious metals? Yes, they're going to run after this. We have the entire world running at it. Now it's just, how long is it going to take for the dollar to get hit bad as well? It's not, I mean, the other currencies, the dollar index has remained strong because other currencies have been so weak. We're talking massive problems in other currencies. And the euro is probably going to be very weak. So anything priced in dollars will remain strong for a short while. After that, I think everyone's going to run into commodities and precious metals. That's just my take on the long-term perspective. How long will it take? That's a really great question. I think next year we're going to find out and see how big this thing goes. I think we're right before it. So, we'll see. I'm in the camp that I'm gonna sit in these things and just wait. And it's going to be a fun ride, and I think it's going to start next year. If you guys like this analysis, give me a thumbs up. Subscribe to the channel if you haven't already. And thank you for listening. This is Finding Value.